Hey guys, how's it going? Finally got a chance to get another investing video put up here. Like most of the previous ones, this one's on the points from Philip Fisher's book, Common Stocks and Uncommon Profits. Anyhow, this one I kind of lumped a lot of those points in together because they were all kind of on a similar topic. And in this case, they revolve around employees of the company you're analyzing and their executives. So I like to start things off with a quick summary for those who don't care to watch the entire video or want to skip around or whatever. Basically, the gist of this type of analysis is about the people in the company, and people are behind every company you invest in, from the employees. You want to know if they're working for or against you. I mean, typically for, of course, but if they're a dissatisfied bunch and have a contentious relationship with the company they work for, they're probably just working to get by, and who could blame them? But anyhow, you want to try to, as best you can, sum up how good of a relationship the employees have with the organization. And then, of course, there's management. The people calling the shots. I've written a couple posts on this on the website there before I kind of move the format over to videos. And it's really, you know, that post was about management's kind of competence, I guess you could say, or, kind of gathering a resume for management to size them up. And that kind of bleeds over in this one a little bit, but it's really about determining, in this case, if management's incentives are aligned with you as the investor, with your incentives, because if they're not, then that should probably throw up some red flags. Also, before we get into it, let me remind you that with all these videos, I put the transcript and the slides up on the site, investthemoney.com. So look for that. I need to remember, if I haven't, to come back and put that link on the video. So I will, I will definitely try to do that. But anyhow, we can get into it now. Uh, like I said, this is on a couple of Fisher's different points. I was able to kind of lump them all together due to having a similar theme. And points 7, 8, and 9 are kind of summarized as follows. Does the company have outstanding labor and personnel relations? Okay. Does the company have outstanding executive relations? And does the company have depth to its management? So we'll start off with the rank and file, uh, the laborers, as you will, or entry level employees, mid managers, even. So there's only so much you can learn without actually working inside of a company. That's way with a lot of these points, a lot of these steps in the security analysis process. And as an investor, you don't have inside information, and so you kind of left with what you do have and piece together as much as you can. So in the case of the regular employees, I guess we'll call them, we can look for reviews from employees on the company and pay info. There are sites out there that have information on that. You got to take it all with a little grain of salt, but you know, sites like Glassdoor, Indeed, other sites like that, they've got at least something that we can reference. Uh, you know, the theory goes from Philip Fisher that good labor relations and good profit margins go hand in hand. Excuse me. So he thinks that good profits plus above average wages will likely equal good relations, or you can shift that equation around in a way. If there's good profits and good relations, there'll probably be above average wages. If there's good profits and good or what did I say, above average wages and good relations, you probably got good profits. So, I would say also check out my other profit margin analysis video, and then the slides again. That's also here on YouTube, and the transcript and the actual slides themselves are in a post on the site. The last thing to kind of consider with the regular employees, the drones, which I'm one of, so I'm not belittling them. I'm a drone myself, unfortunately, but anyhow, is to look and determine first of all if they're unionized, and second of all what the relationship is if they're unionized. Like I said, that's not necessarily a bad thing. There are unionized companies that can work pretty well hand in hand with their executive counterparts, or the organization as a whole. And then obviously there's the other extreme. So we'll start with the employee reviews and pay. And like I said, you can use Glassdoor, which I did in these screenshots down here. And, with anything, when you're doing security analysis, it's a good idea to have a benchmark, because every industry is different. It just helps to add context to whatever it is that you're analyzing. So in this case, I think a good benchmark is the best places to work. Okay, so you're basically looking for some of the best places to work according to Glassdoor, which is according to their users. You look at NVIDIA here with a 4.6 rating, 99% approved of the CEO, which is really pretty remarkable. On an internet site that really anybody can get on and leave a review for. Um, yeah, so NVIDIA is one of those highly regarded companies. And then we've got Helen of Troy over here, which was a company that I had looked at in some of my previous posts on Philip Fisher's 15 points. But you can see that, and now obviously these two companies aren't in the same industry. You could, you know, frankly, if you can do it practically, it would be good to compare against the best in the industry. But the chore with that would be, of course, looking up every single company in Glassdoor that's in the industry, making a note of what their star rating is or their CO approval rating is. And, that could be a little tedious. In this case, I just compared Helen of Troy side by side with NVIDIA, which is one of the overall best companies to work for. So it's really a matter of how much time you want to commit and effort. But anyhow, it works for, in this case, as an example. But read through the reviews, get a feel for uh, how the employees feel about the place. You can have reviews at both extremes. You'll like looking at product reviews. If something's a 1-star review, but is like misspelled and the grammar stinks and that, I mean, that still counts towards that star rating, but not to give it that much clout. Likewise, if something looks like it was written by the PR team, then you can also disregard that. It's all beaming and everything, and doesn't lack or doesn't have any real substance. So, this is uh, compare the star ratings, but it's also a little bit of a qualitative analysis. You got to kind of sum it up. Um, you know, it, or really can't sum it up. You've got to kind of figure out, just go with what your impression is. So let's see. So on the other side of the screen here, we've got compared salaries. In this case, between one company that I've also looked at in previous post, and that's Energizer and Energizer Holdings, and compared it to Duracell. To look at salaries, because again, um, Fisher maintains that above average wages and good relations contribute to good profits. So you can see that they're in a little different format here. And this, I believe, was also off of Glassdoor. Admittedly, it's been a little while since I put this slide together, so apologies if I'm mistaken there, but I think this is on Glassdoor. And you see here, if you dig around a little bit, you can compare. We got operator here for Energizer and machine operator for Duracell. Looks like the we can't know for sure that it's the exact same job, exact same skill level, etc., but similar at least. And the 10, 17 an hour is actually going to turn into what, 21,000 a year or something like that. So considerably lower than operator Energizer is getting paid. And you know, you can do the math, of course. It's you might not always be able to make a direct comparison, but the information's there, and again, you'll never know for sure if you're comparing apples to apples. So take it with a little grain of salt. You're just looking for an an overall impression, like I said. So then you can kind of ascertain what if you think that the better relations, the better pay are translating into better profit, particularly if you do a gross margin analysis on a company and its competitors. Then, like I said, you can really have a great idea of how much impact those factors have on profit. So, like I said, this is on YouTube and it's also on the site here, the video on profit margin analysis, gross margin, operating margin, net profit margin, where you can see the slides and the video transcript if you want to search and figure out where to jump to in the video. And also that video is on YouTube too. The analysis you do here in terms of employee reviews and employee pay, you want to do in conjunction with profit analysis. Okay, so we touched on a little bit earlier, that unions are a big deal for the companies that have employees that are unionized. That the negotiations that take place between the unions and the employers, I mean, can have, obviously enormous impacts on the company, enormous impacts on employee morale, as it may be, and the quality of employees they're able to attract, and all those sorts of things. So you definitely want to size up, first of all, whether they have one, and a good place to do that is to search the 10K for the word union. I used an example here. I don't remember who it was. I think this was Boeing or something, and kind of shrunk down there, but so apologies for that. But basically, all I did was open their 10K, search for the word union, and it comes down here under employees, and it talks about what percent of the employees are represented by which unions. You can see, I'm pretty sure, like I said, this was Boeing, so you can see I got 3 unions here. International Association of Machinists and Aerospace Workers, Society of Professional Engineering Employees, and Automobile Aerospace and Agriculture Workers of America. So once you ascertain whether they have a union, then you've got to, again, make kind of a qualifying analysis as to what the relationship's like. So, that's as easy as getting on your favorite search engine. Google's not my favorite search engine, by the way, even though I use them a lot. But just search company name and unions. Okay, look at the news under the news tab, and start reading. You know, again, you're just trying to get a feel for what that relationship's like. You would, eh, and it might surprise you in some cases. I know if you're looking to invest in a prospective company, you want to know if that sort of thing's on the horizon as best you can, anyways. So that kind of covers everything on employees. So let's talk a little bit more about upper management here, particularly executives. And, as I was putting together the notes for um, this particular video, it really started to kind of sink in with me that I think it's a positive thing when a company is either ran by its founder or at least by the founding family, the Waltons at Walmart, for example. There just seems to be a better alignment of interest, more skin in the game for the founder. It's their egos tied up with it. They obviously stand to make a lot of money the more successful the company is. Usually they have a huge ownership interest, which we'll talk about that in a little bit here. But um, I hadn't thought about it much before putting this together, but I think I would definitely give some weighting to companies that are ran by their founder, or like I said, the family at least. But admittedly, even then, kids that grew up with a father or mother, as it may be, I don't know, but that were busy working all the time, building an enormous company, and then grew up with insanely rich and that and everything. That's not a recipe, I think, for a completely healthy individual. It's not to say they can't come out of it that way, but it, I, hopefully their family has, learned under the tutelage of the founder, and carries the same zest for the business. If the founder's since passed or whatever. It, to sum it all up, though, I think it would be best if, ideal when a company is still being run by its founder. Uh, Other things to consider is, the compensation in line with the competition, and does it align the executive's interests with your own? Okay. And the last thing, and this is one that um, Fisher touched on, and he, does the company have depth to its management? Well, he was in a little bit better position by, doing his scuttlebutt, as he called it, and talking directly with executive management to understand this. Then most of us are going to be on our computers, you know, dealing with whatever we can dig up off the internet. But we'll touch on it nonetheless. Okay, so a family-owned, operated, or founder-owned, operated business, has skin in the game. They typically are going to have a big ownership interest, and the value of that company rising and falling is going to impact them almost certainly to a greater degree than it is you. And maybe not as big an impact on their net worth as yours, of course, but if the stock tanks, they lose a considerable sum of money too. So, like I said, they have skin in the game, uh, and I think that's a positive thing. You know, our, it makes them more than just an employee or an agent. They're this is their baby. If it's the founder, or it might be their family name on the product, or the company name might be their family name. And I mean, there's just something to that, I think, as a kind of a motivator to you know uh, project to do right by the company, to make it successful. On the flip side, you've got, yeah, I'm a bit of a skeptic. There are good executives out there, I suppose, and but a lot of them are just buffoons that have failed upward. They went to the right school and got the right job and kissed the right ass and have, just managed to deflect any of their shortcomings and to become executives. Like I said, that's comes off, I'm sure, as a little harsh or that, but if you've worked a job in a company, it doesn't even necessarily have to be a public company. You've seen it. It they're like I said, they're good executives, good managers, but you don't have to be good to be an executive or manager. It's a coin flip at best. I personally apply the 80-20 rule, saying there's probably 20% of the executives out there are worth a shit. The other 80%, just somebody has to fill the role, and the board of directors decided they were best suited for it, and so here we all are. But that's a determination that you need to make, and the whole reason we go through this exercise. So, but again, to hammer the point home, if they are the founder, then they are not just an employee or agent. Employees and agents, I would think, have a greater likelihood of having a short-term mindset, getting paid what they can. They're concerned that they're going to be found out as frauds, and uh, I don't know. Those type of people always seem to land on their feet, but they're trying to get paid as much as possible, as quickly as possible. Whereas a founder that by default would have a longer term mindset, but hopefully you're if it's an employee executive team that they are incentivized in such a way as to give them a long-term mindset. But to play devil's advocate, you don't want one of those rare good executives to get overshadowed by family promoted, get family promoted ahead of them just because they're family through there's a term for it. It's eluding me now, but you know what I mean. Um, that's a very real possibility. So that's kind of the other side of the coin there. And if you do have an employee executive too, I think it's important to do a little bit of analysis in as far as who's the largest shareholder. Okay, and what that will tell you is possibly what their track record with hiring is. So, for instance, as I looked at, I think it was Bank of America, and their largest shareholder was Berkshire Hathaway, which is a mutual fund in a lot of respects, but also has a very well-known executive by excuse me, by the name of Warren Buffett. Okay, well, Warren Buffett's got a track record that you can investigate in terms of hiring. Okay, uh, so if in this case you're going to have an employee executive, um, you know, you can. It might help your confidence in him if you determine that Warren Buffett does an excellent job of hiring executives. You know what I mean? The flip side is if you have an employee executive for another company and the largest shareholder is some mutual fund, um, yeah, that wouldn't give me the confidence that it would, in the case of like a Warren Buffett or some other individual who might have a reputation for making good hires. So, executive compensation is a hot button issue, of course, and this is not a video to make a claim either way, I guess. It's going to be a shitload of money no matter what, in one form or another. Even if they forego their salary, like you've heard some people doing this year in light of the whole coronavirus mess. Um, yeah, there's still a lot of money to be had. So, the first and foremost, when you think compensation, you think salary and bonus. Okay, so these are both short-term incentives. Okay, it's all about what happens in this year. Particularly bonus. I mean, salary is a given. Um, but an individual has a good year, they're in a better position probably to negotiate for higher salary also. But bonus is the big one. These are both cash compensation, and bonuses typically are going to be a fixed percentage of sales or profits. So the bottom line is you don't want it weighted too heavily in the salary and bonus columns. Rather, you want to look more to long-term incentives and particularly restricted stock units. And these have become more popular uh, over the past, what was it, like the mid 2000s, I think I read that they started to do this in lieu of stock options in a lot of cases. And it's just basically stock in the company. The whole restricted part of it is that, it, as they're granted, then it takes time for them to vest, typically over the course of years. And once they're vested, they can be sold. You can contrast them with stock options, which are the right to buy, so the employee has to pay money. The right to buy company shares at a predetermined price. And that predetermined price will vary. Once the options are vested, it's again over the course of years, meaning that an individual, vesting it essentially means, if you're not familiar, they're going to get 10,000 of something. It can be stock units, it can be options. Vested over 5 years would be 2,000 of that thing given to them every year. Okay, so it's just like that's you know that's in and of itself a little bit of a long-term incentive, but both these go beyond that in that if you're just given stock and then you own stock, you want it, and you have the ability, directly as an executive to impact the value of that stock over the long term. Well, to make it go up, and hopefully that's what it'll do, since you know probably not as much as a founder would have, but you're getting the opportunity to own, have a significant piece of ownership in that company, and then hopefully, like I said, that will tie your interests with those of the investor. Those are the big components of executive compensation. There are others like supplemental benefits, deferred compensation, uh, you know, um, This should all be indented. This is all under that SERP there. And that's just basically a pension, and it's 70% of the executives, for example, could be 70% of the executives' high 3-year average compensation. So um, if, their salary and bonus was averaged $1 million a year at its peak, then they'd get 700,000 a year for the rest of their lives. Not a bad deal. Perquisites, which is, I had never heard the word, but I guess that's where perks comes from. Things like use aircraft, sporting events, club membership, and then of course you've got golden parachutes. The perks don't really, I mean, that's not a material part of their pay. So unless it was something insane, I wouldn't pay it much mind. But golden parachutes, on the other hand, can be insanely big. What was it? Steve Wynn, I think, has the biggest ever, and it was like $350 million or something. You know, what that was in relation to the overall market cap, I don't know, but boy, it had to have been. I don't have. It had to have been material, I would think. Maybe not, but it's worth investigating anyways. And golden parachutes are kind of a double-edged sword. They can be a disincentive to do a good job because if you get paid an amount of money like that, and Steve Wynn's was the by far and away the biggest, but if you're dealing with a smaller company and it could be the golden parachute could be, like I said, a material part of the overall market cap. Um, we all wish we had that. I mean, he, it could be a disincentive to do a good job because, hell, you run the chance of doing less work, having less stress, and getting paid more if you get fired. So the other side of the token is that it could reduce conflict of interest during a merger. How that works. So if an executive, is being approached about a merger and knows that once the merger is complete, they probably lose their job, get their golden parachute. They might work to avoid having the company absorbed. You know what I mean? If the terms of the merger aren't fair, like I said, it can kind of work both ways there, but I think in large part is generally a disincentive. That just leaves, as far as executives are concerned, the depth to management determination. And, again, I covered this before. Does senior management have the right qualifications? And that'll go over the executives. Now, the people that would be quote unquote next in line to be executives, and it's a bit of an antiquated notion, I think. Philip Fisher's book was written back in the 50s or something. I don't remember, 40s maybe. People were more kind of long-term oriented with employment. So, his take on it, if I interpreted it right, was that basically who the next generation of management was. Your VPs and that sort of thing, because they're the ones that would be executives one day, and there's a possibility, but I just don't think that's as, like I said, applicable in the year 2020 and beyond as it was back then. But anyhow, you definitely do want to get to know the current management, and so check that post out. That'll walk you through that. Without working there, you're not really going to know who the people next in line are, short of snooping around on LinkedIn a little bit, and even then, that uh, that just depends how deep down the rabbit hole you want to go. I don't think that is the most practical use of time and effort, but it's what you can do if you want to know about it. So that pretty much covers everything. I end every video pointing out that security analysis, if you do it thoroughly, is a long and complicated process, and It can be difficult to know where to start, particularly if you spend a lot of time getting to know a company and determine that, hey, they're a bad investment. Well, then that was sunk time in a lot of respects. So if you want to avoid that, you might check out Capitalist Exploits. They have a newer publication called Insider Weekly, and it's $1 for the first 30 days, real cheap. Besides that, the Capital Exploits people have a free newsletter and an updated blog, and well reviewed on Trustpilot and everything. So I'll post a link to them in the video description, and urge you to go check them out. So anyhow, that's all I got on employees and executives. Appreciate your time if you stuck with me this long, and hope to get another video out a little sooner next time. Take care.